going to start off with some fairly broad questions. And our first one is really to ask whether the hardening market is impacting all markets, and if it's just particular classes or country, you know, what is the various impact? So I don't know who would like to start off with that sort of Pan-African view. I don't know, Lawrence, whether you'd like to, or Nico, whether you'd like to come in straight away and just talk about, you know, which markets are being impacted most by the hardening market.
I'm sure Nico would have a better view of that, because I haven't started seeing the hardening yet out here in Lagos. I think it's hardened for the reinsurers, certainly, yes. But I think we've got limited capabilities in terms of making sure that it filters down the value chain to the direct insurance companies. We certainly saw significant hardening of both rates and terms, you know, fairly scrupulous reviews of wordings and reviews of coverages on our retrocession programs. We are paying probably between 10 to 20% more in terms of our excess of loss cost as Continental Re right now relative to what we paid for 2020. And that's a fairly significant increase. And we also did have, you know, we lost quite a few of key, you know, retro partners and securities in the process who were not happy in instances where the hardening did not measure up to the expectations. So there definitely is, as far as we are concerned, a mood that things have changed as far as pricing for protection is concerned. But on the direct side, we see our clients going along pretty much as if nothing has happened. We are still seeing attempts on fairly significant exposures, significant, you know, risks. We are still seeing attempts for, you know, moderation of terms. We are still seeing attempts for discounts, but we haven't seen any significant hardening, if I may say. What we believe is going to happen, and it has already started happening, there is a lot more scrutiny of wordings. I think in the initial instances last year of COVID, all of us were saying there is no impact, except probably on the life side. And right now we have seen that, you know, after our brokers and clients have had a look at their wordings, we are seeing claims of magnitudes that we never anticipated filtering through. And all of us have become a lot more scrupulous about what we are writing. We are going back to our dusty, filed away wordings and reviewing to see what might be lurking in there that we were not aware of. And I think going forward, particularly for the remainder of this year, that's where most of the change actually is going to come from. Us being a lot more scrupulous about what we are putting on our books in terms of writing. I believe it's going to take longer for hardening on the actual race. And my view is it's primarily because of the basis upon which most capacity is bought in Africa. It's on a proportional basis. And I think that's one area that we all have to take a closer look at to ensure that, you know, in the process of giving away automatic capacity, we then lose our ability to be able to pass down costs, higher costs that we are seeing in the global markets. I think that's all I must say, but I think Nico would have seen, probably because the market is a lot more sophisticated, a significantly different scenario in the South African market.
Liz, thank you, Lawrence, for the cue, and thanks for the opportunity. It's always difficult speaking after Lawrence because he's done such a good summary that I'm tempted to say ditto and agreed, but I will try and add one or two bullet points to that. Fully agreed. We see definitely globally and also on the continent a flight for quality, definitely increasing prices more than just the risk-adjusted price increases, and as Lawrence has also said, improved terms and conditions. wordings that are dusted off and tightened up to that everyone would be clearer on what the actual intent of the wording is. If I just touch on the SA market sort of as a second bullet point, certainly our market has been affected by enormous losses over the last 3-4 years. Some of you may recall the famous Nazare fires that caught us by surprise. The business interruption claims by COVID of last year. Also, our life market has been devastated by the mortality claims from COVID. And now that we're in the middle of these civil unrest riot situations in the country, this will again be a huge loss to the market. So certainly, just driven by the large events, it is imperative that the market takes cognizance of that, and that prices would harden and that capacity would shrink in some respects. We see some players having suffered significant losses, not being active in the market anymore. Probably decided that South Africa or Africa is a dangerous place to do business, and that one should be careful of employing too much capacity here. Maybe as a last comment from my side, I do think that most professional reinsurers don't have a blanket or generic approach toward price increases, but that we all take quite a careful look at our clients' exposures and portfolios and their own experience. So it is not a case of that it just is a generic blunt price increase throughout the class of business or the client profile, but that where we see needs for price increases, that we do put that through, and that we trust that it will also flow through to the underlying market. So overall, it is a hardening market, and we believe it will also flow through to the underlying markets. But we see different trends in different countries, South Africa being most hard hit by price increases due to the losses, and then more muted effects in other markets to our north. I'll conclude with those comments, and happy to hear from others their experience. Thanks, Liz.
I would agree. We are present in practically all markets in Africa, including South Africa. So I agree with the previous comments in the sense that, yes, on our retrocession coverage, we've seen the terms hardening more than proportionally in terms of prices, especially than what we have been able to implement on our own coverage we are giving to clients. Of course, some classes are showing more hardening than others. I would say classes that were more affected by losses, like property, obviously, more affected by the hardening, both in terms of cost, but more importantly in terms of terms and conditions, like the introduction of communicable disease exclusions. Those are systematic, and those are terms we are also largely able to implement in our markets. I could also mention like aviation, more to do with the previous losses suffered in the particular class than to do necessarily with COVID. So that's also an element to mention. Then the other important thing to notice is that markets that have suffered such losses are more amenable to accept, some increases, some reasonable increases in prices, and some changes in terms and conditions than markets that have not suffered losses, because they understand where we are coming from. But definitely it has been a problem where we have not seen losses and you are trying to implement those terms and conditions. There's much of resistance, and also there's hardening on our part, but not no commensurate hardening in those markets. So I think those are the few points I wanted to add.
It's more of an opinion, really. People can disagree with me. I'm sure Mr. Oates might do as a Lloyd's person. But yeah, for me, the hardening market started before the pandemic. I believe this the change happened maybe as early as 2017, but definitely into 2018. And I think the pandemic, in my opinion, is it's just accelerated it. So I'm not sure the two are linked, but I think there was an acceleration process of the pandemic. So that's my opinion.
Yes, I do agree with you. Yes. And I think it was motivated, it started, the engine for it was the series of hurricane losses in the US, as quite often is the case. It impacted reinsurers' results. And so that goes back, as you say, to about 18, where people starting to realise that they weren't getting any margin, and that, in fact, that a certain amount of capital had been eroded because of those cat losses, which have continued. I mean, last year, aside from COVID, was actually quite a significant cat year in terms of attritional losses. So that those pressures remain there, and therefore the capital that reinsurers are employing is a little bit more expensive, because when we go to the market, then there's a higher expectation from our capital providers. So it's kind of passing that down the chain.
In terms of business in Africa, now, because we're in London, we see the global pressures on pricing. We see where things are going. And our pricing models, which are fairly sophisticated, allow for the cost of our retro, and Trevor charged us a whole load of extra money for our retro. Thank you, Trevor. Despite knowing me as a friend, it didn't help the situation. I think it made it worse, actually, but that's a separate topic. And we know what the prices for similar risks internationally are. However, we're not seeing that translate on a facultative basis to the pricing of risks that we see on the continent. We're seeing some rate rises, but nowhere near where I think rates should be if you benchmark Africa versus similar markets for similar types of risks where they suffer similar perils. So I think there's a long way to go, and I can understand why there's pressure, because if there's been no claims for the last 5 years, the clients are going to say, well, you've had no claims, from my argument's sake, wind farm in the last 5 years. Why are you pushing up my rates by 40 or 50%, which is what the market's saying, the global market would suggest. And so whilst we have been putting out prices which reflect the global environment, we've seen that on the ground, the local pricing has not moved anywhere near where the global environment should be. And now that has two impacts. First of all, it means not only reinsurers like us get squeezed, but it also means that the insurers also get squeezed, because we're still going to charge reinsurance rates to the insurers for those who are providing treaty. We don't provide treaty at the moment. And it squeezes profitability. But what that does also is that the insurers and the reinsurers can't build enough reserves to pay claims when they fall due. So there are market issues that we need to think about in order to improve resilience in the African market as well. And we've been fortunate, as Nico said, that many international players have pulled out of Africa. It's allowed us an easier route into the market. And thanks, Ryan and Udai, for showing us business. We appreciate that very much, and being supportive. But for all of my other colleagues here as well, it is important that we somehow find product ranges that work for the right price, for the right risk reward, because I don't think we're always getting the right risk reward in Africa. Please feel free to disagree. We're willing to work with everyone to show how we price risks and how we can deploy capacities as a combined entity. And the last thing I want to say is, in a situation of price hardening, if we can get prices to reflect the global reality in Africa, then there's an opportunity for more of the risk also to be retained in Africa, because the pricing justifies more of the risk to be retained in Africa.
Thanks. Look, I think we need to also embrace the fact that we live in a global village, because we don't have the capacity to retain most of the risks and exposures which sits in our African markets, because if you know that look, there's Africa Re, there's Continental Re, there's Zep Re, and many other insurers in the continent who also access their capacity from the London market. And obviously, like Trevor and Ryan have said, we accessing that capacity from the London market also sells capacity all over. And the events happening all over the world obviously will have an impact in the way we do business in Africa at the end of the day, because we provide the reinsurance capacity to the African clients, and also in turn we buy retro. So if we face price increases there's obviously need for us to cushion ourselves. Going back to the impact of COVID, I think COVID has had a serious impact on most of the key markets in Africa. I'll probably touch on Eastern and Central Africa. That, like Trevor said, I think some of the revision, the improvement in pricing started long back. I'll give you an example for Kenya, which is the biggest market in Eastern Africa. It has had negative returns for the past 5 years, and the reinsurers felt that there was need to bring underwriting discipline. But now came COVID. COVID has affected quite a number of classes. I think in the past year, all classes but aviation had positive growth. Aviation grew, I think, because of the hardening of the markets all over. But property has been affected because most of the hotel industries are operating at below capacity. The productive sector is also operating at below capacity because there have been lockdowns. We have seen that, look, the MF is saying Kenya will grow by 7.6, Rwanda, I think 5.7, Tanzania 2.7. We don't believe those growth rates are going to be achieved given the impact of COVID. You can see, I think Kenya is expecting a fourth wave probably next week or week after. And that is obviously going to impact the markets going forward. What we have also seen is that the life and medical have been hard hit because in Kenya, we have seen 1.7 million people losing their jobs. In Uganda, 800,000 people lost their jobs. If you go to Zimbabwe, I think I'm told about 500,000 people lost their jobs. So the growth in the life sector is also continued to be depressed. Life used to be very, very, very much profitable, but profitability has been affected, especially by the impact of the third wave. We have seen quite a number of senior people dying, losing their lives in Uganda, in Kenya. Right now, the performance of the life business is going into negative. Medical has always been a problem, and we have seen that government is now running out of money to fund some of the medical costs. They are trying to push regulators to find solutions, and the regulators are engaging senior executives of industry to see if the industry can fund some of the costs. But it's very difficult because the industries themselves are also suffering. Yeah.
Thank you, Liz. Mine was an observation and a comment more than a question. Just picking up on the initial comment that Lawrence made, that the terms and rates for reinsurers seem to be hardening, but they've not filtered down to the insurers as yet. And my comment was that maybe it may even be an interesting study for someone to carry out in the future. But if picking up on Ryan's and Trevor's comments earlier, that the global hardening of the market started back in 2017-18, and COVID was effectively the fuel that accelerated it when it comes to Africa. Maybe what we are seeing at the moment is a period of adjustment more than anything else, and the rate of adjustment during which these hardening of rates and terms filter down to the insurers takes will depend on the extent of the insurance penetration country by country. So we know one of the factors where the insurance penetration is low in a market is because of price sensitivity in those markets. And maybe the rate at which these hardened terms will filter down will be longer where the insurance penetration is lower. Maybe it's an opportunity for someone to do a study, and once you have established that scientifically, you can find a solution. Just a comment.